Good afternoon. Good afternoon, everyone. Hello. Welcome, everyone. Welcome to the
Hi.
final week of the MSDUK Accelerator. What a journey it has been. We are in the last week, last few workshops of this week, and that is it. So welcome, everyone. I will let everyone connect to audio so that we can get started with the session. Some really good sessions. It is sad, Raisa. It is sad. We have been on a journey together since January, and it is now May, and we are nearing the end of the program. So welcome everyone to the final week of the program. I think everyone has connected to their audio. I'm coming to you from Leicester, so we actually had a team day today. So I'm having to quickly jump out of the team day to bring this workshop to you. We didn't want anything to interrupt this workshop though, so we're still bringing it to you despite the team day. But I think everyone's just about connected, so I will welcome you all to the first investment workshop of this week and the first workshop of the last week of the program. So welcome everyone to the investment workshop, first one, led by our amazing guest speaker, Masamba. He's been with us since cohort one. He is an investor at MMC Ventures. I'm sure he'll be introducing himself during the presentation as well, and he'll be bringing his insights into investment, into his work with businesses and what it takes to get investment from investors. So he'll be bringing his insights and his expertise into today's session and tomorrow's session as well. So I will hand over to Masamba, but please keep everything interactive. If you can, please keep your cameras on so that Masamba can see your faces. Ask questions. Masamba will be also asking questions as well. So feel free to go off mute or answer in the chat as well. But let's keep this interactivity going that we've been keeping for the past 4 months as well. So Masamba, over to you.
Thank you for the intro. Hey everyone. Hope the Accelerator program has gone well so far. And yeah, I mean, you're right at the finish line, which is quite exciting. So yeah, I'm gonna share my screen and jump into things. I guess we have 2 sessions together, so you're gonna have to stare at my face for 2 hours, unfortunately. Sorry in advance. But yeah, today is the first of them, and we're following up tomorrow. Today is going to be focused on the investment process itself, kind of going out there, raising around investment kind of do's and don'ts, some of my tips and tricks, let's call it. And then tomorrow is a deep dive into valuation and term sheets. And so, yeah, we'll go through all of the very, very, very fun legal terms that you have to deal with by the point at which you've, kind of signed terms or preparing to sign terms and close off your funding. So yeah, I'm going to share my screen. Okay. Give me a thumbs up if you can see that. Yeah, all good? Okay. All right, I'm going to start off with a quick intro to MMC. And I guess an introduction to myself as well. Background on myself, Masamba. I've been at MMC for about 2.5 years, and I guess been investing in early stage startups for about 4 or 5 years now. Prior to MMC, I was investing, but at earlier rounds. And so I actually started off at a micro fund that was basically investing into students who were building, whatever crazy dreams they were coming up with in their dorm rooms, in their labs, and trying to commercialize that and bring it into the real world. I then started to do that, but at a larger scale. So I was writing larger tickets with a fund called the Accelerator Fund before I spent a bit of time with Episode 1, who are a seed stage deep tech B2B investor. And for the past 2.5 years, have been a part of the MMC investment team. So I guess, who are we? Who's MMC? We are an early stage fund, have been around for about 23 years now. So on the older side when it comes to UK VC, north of $1 billion when it comes to AUM, and have had the pleasure of partnering with over 150 companies at this stage since our inception. And so today the MMC family is about 70 large, and yeah, growing kind of quarter on quarter, I suppose. I think we're soon enough going to hit 80 and then, beyond. And yeah, in terms of kind of active portfolio, we've backed companies like Gusto, like, Bloom and Wild, and other names that you may have heard of here and there. And some of our more recent exits as well include the likes of Interactive Investor, which was sold to Aberdeen for $2 billion. And yeah, we've had a few large exits to US acquirers as well, such as Brightpearl to Sage and Current Health to Best Buy. I guess today, what are we investing in? MMC is a Series A stage investor. And I would say we bucket our activity into 5 different streams. And so that spans across the world of fintech, enterprise software, cloud and data infra, of course, consumer as well, and consumer experiences. And so companies like Gusto, Lucky Arrow, and the world of digital health, which we're increasingly more active in. And yeah, I guess that's a relatively broad range, but the thing that underpins a lot of the companies that we invest into is they are very data-driven in the way that they operate, whether that be in the products that they're building, having machine learning embedded within them, or the services that they are, offering to their end customers being very data enabled. You take a Gusto, for example, you'd be amazed at the amount of automation and data science that goes into the meal boxes that they deliver to people's doorsteps to be able to, predict what people want, make sure that your inventory is of the right level, et cetera, et cetera. And so, yeah, I would say that kind of categorizes our investing for us, at least, into what we call transformative technologies. Again, it's a lot of machine learning, a lot of data science, people who are introducing new ways of operating, new business models, and also rebuilding infrastructure. A lot of the companies that we've invested in, we kind of see as picks and shovels on the cloud and data infrastructure side, on the enterprise software side as well. And so, yeah, this is just a snapshot of today's portfolio. I feel like this is outdated every other week. So, yeah, we desperately need to update this, but this gives you a sense of kind of some of the companies in our portfolio today. The team behind that, I guess, story behind MMC is it actually started off as an angel syndicate and then commercialized into a fund and grew and grew and grew. So it was founded by Alan Morgan and Bruce McFarlane. Alan was a partner at McKinsey. He was there for almost 30 years and led their financial services practice in EMEA. And Bruce was a managing director at Merrill Lynch and leading their European investment banking division at the time. You can see my little face down there as one of the associates on the team. And so I'm doing everything sourcing, research, deal support, and execution as well. And yeah, the team has kind of been everywhere, done a lot of different things. We have a former F1 engineer over here. We have a neuroscientist here. Andre used to work as an engineer in data centers and so on and so forth. So the experience that everybody brings to the table is relatively diverse. So enough about us. I guess moving on to what you guys came here to hear. I'm going to try and go through the presentation relatively quickly, just because I'm conscious that you guys have a number of questions coming into the presentation, and you'll probably have questions on some of the different slides that I show. So, feel free to put your hand up and stop me if there is a question on something in particular. But I always find that the most useful part of these interactions is actually the Q&A at the end, just to kind of answer a few more things that are maybe a bit more specific or useful. So yeah, let's get into things. I'm going to start with a question to you. How many companies do you think we sourced last year? So through 2022, maybe if you put in a number in the chat, how many companies do you think kind of came into the MMC funnel, let's call it? Okay, got 120K, another 20K. It's a popular number so far. I would say, yeah, 20 is large. We're lower than that if anyone wants to. Oh, approximately 180. Okay, I like the confidence. Less than 100. 12.5. Okay, 5K. All right, I'm going to say that Sunny is the winner, or at least closest. Last year, through kind of all of our different methods of sourcing, I'd say we pulled in about 3.5K new companies into our CRM, which means in our CRM today, like where we kind of hold all of the information related to companies of interest, companies that we've come across, are probably north of 10,000. But in 2022 alone, we sourced about 3.5K. Say that top line number is trending upwards and upwards as we kind of crunch through a lot more data and become a lot more data driven in the way that we do things. And so this here is becoming more important for a lot of VCs. But if we move all the way through that funnel, okay, 3.5K sourced. Across the team, we met about 625. And yeah, kind of through the different stages, we ended up investing into about 16 of those. So 5 at Series A, which were larger tickets, and 11 at seed. So I guess from 3.5K to 16, it's a lot of whittling down. It's a lot of decisions to make, either very quick decisions, or maybe after we've had a meeting, then making a decision, or even beyond that at a point of due diligence. And so, of the companies that we met alone, not the companies that we sourced, but of those that we met, it was about 2.6% that we ended up investing in. So I guess the point of today is, like, how do you make it through that funnel? How do you become one of those 16 or a part of that 2.6%?
Sorry, Masemba, can I just ask a quick question, please?
Yeah, go for it.
Sorry, I'm not on screen, but could you just go back to that slide with a funnel? I just wanted you to talk me through the stages of the funnel. So when you say 3,515 companies were sourced, I presume that those are 3,500 odd companies that have declared an interest in getting funding. Is that right?
I would say probably something like half of those declared an interest directly to us, so we're inbound, and then the remainder were outbound / us finding them.
Okay, so the next level of 625 are, would I be right in thinking those are the companies that you thought had some prospect of taking?
Exactly.
Yeah. Okay. Right. Okay.
So those were active fundraising discussions at like a first round meeting. The layer below that is when we involve partners in our team. So usually it'll be myself and some of the other associates who will do a lot of the sourcing and have a lot of the early conversations. And then we'll bring things in to some of the partners who will, perhaps sponsor a deal. And so the 83 there is, okay, we've decided that we're interested. They're fundraising. We have a partner meeting them. And we're taking a decision together as a team at that stage as to what the next best, course of action is.
That's the interesting stage for me. Are there any common attributes that you are looking for in order to get from the 625 to have a team meeting with you and your key partners?
Yeah, I guess that's what we'll probably get onto that. That's kind of the gist of the presentation overall. And then if there are any points, if there are any specific points that you think I haven't answered, come back to me at the end. But let's save that thought for now, if that's okay. Okay, any other questions before I move on? Okay, I guess, so how do you make it through that funnel? By the way, Glanville, great questions. And we'll dig into things. I guess starting off, before we get to stage 1 as it is, there's almost a stage 0. There's a go or no go, which is you're deciding if VC is for you. And part of that is understanding the asset class that is venture capital and what exactly it entails. And so, it's deciding, is VC for you? There are a lot of different forms of capital that can fund a business, right? Whether it be in the form of equity, and therefore, which route do you take? It could be angel investors, family offices, crowdfunding, or maybe in the form of debt or, kind of a revolving facility, for example. I've met companies who have funded themselves up to a certain point through any number of securities or methods. I guess the first question is VC for you? One of the things that you have to understand is that with each investment that a venture capitalist is making, they're assuming that you're going to end up somewhere towards the left side of this power law distribution, meaning that if they invest in, let's call it 20 companies in their portfolio, each company needs to have the potential to be that outlier that returns the fund, right? So each company needs to have the ability to be, kind of many more times valuable than the point at which they are investing. And that has implications for you. It has implications for the way that you run your business, the way that they encourage you to run your business, and the pace at which they encourage you to grow. And so it makes for, of course, a very different way of operating and also a very different lifestyle. And so the way that I see it, if we're investing into a company, there's almost this implicit contract that we're signing with the founders that's saying, okay, this is with the expectation that this is going to be a very large outcome, but also a very large outcome in a relatively short amount of time, which means, it's kind of foot on the gas for a while as well. And so key to making that decision is understanding the models of VC funds. Now, this is a relatively simplistic view, but let's say somebody raises a $50 million seed fund. Immediately, we're going to take something like $10 million out of that for management fees over the life of the fund, assuming that, they're deploying for maybe 10 years, or the life of the fund is 10 years, and they're taking something like 2% year on year. So let's say they only have, out of the 50, 40 to deploy. often investors will split that between their first time checks and then their follow-on checks. Because of course, you'll invest into a company, but you will assume that those companies will continue to raise rounds of funding. And for a while, you're going to want to invest, assuming that they're performing well, to either protect your stake or build your stake. And so if we slice that pie right down the middle and say half of the remaining capital is for first-time checks and half is for follow-on, maybe in that seed fund, they invest into 20 businesses with $1 million each. Each $1 million check needs to basically be able to accrue to a value of, it needs to be a fund returner. And when we say fund returners, we mean it needs to accrue to the value of at least the fund, like the size of the fund, ideally more. And so if I invest $1 million in this business today, assuming some level of dilution, let's say I assume 50% dilution because you're going to raise tens of millions or maybe even hundreds of millions. I need my kind of initial 10% stake, let's call it, that's diluted down to 5 to at one point be worth 50 million. And so, yeah, like, again, that means that ideally this company would become a unicorn. Ideally, this company would get to $1 billion in value to be able to at least be my fund returner, if not more. And so that's the kind of implicit contract here. It's saying, I need to grow my fund by 3 times in the next 7 years, let's say. Which is usually the benchmark for what good performance looks like. That is overachieving what public markets are returning. That means that every company, like I need a few outliers. And so every company needs to at least be a fund returner, if not more, because the assumption is that unfortunately, most companies aren't going to reach that level of value. And so I need the companies that do reach that level of value to kind of be more valuable than all of the others that unfortunately didn't. And so, yeah, again, that has implications for how you run the business and the pace and scale at which you need to kind of go on this journey. And so one of the kind of benchmarks, for example, for the world of B2B SaaS in particular is the kind of T2, D3, meaning from the point at which, let's say you're reaching $1 million in ARR, and so probably raising a Series A. The kind of expectation for an investor such as ourselves is that, ideally by year 5, you want to be reaching a large outcome. It could take longer, of course, and we're more than fine with being patient. But if you look at some of the top quartile kind of SaaS companies and their growth, whilst they were private, they will typically T2, meaning triple twice in terms of top line revenue, and then double 3 times. So it's like 3x growth in your first 2 years. And then doubling and doubling and doubling again on top of that, which is kind of that path to $100 million in ARR. Most companies don't grow like this. I probably should have, made this caveat at the start, but most companies do not take this journey. We've had companies become, unicorns who did not look like this and had longer journeys as well. And so it can take longer. We've seen 1 or 2 companies actually reach this in shorter amounts of time. So everyone's journey is going to be slightly different. But in taking VC funding, there is this kind of assumption of fast growth in the company. And so it's aligning yourself to that. And also it's you making this judgment call, this assumption that your market is large enough for you to be able to reach that level of value in a relatively short amount of time. And so, yeah, it's kind of looking at your addressable market, the kind of value of what it is that you're selling and what you think that level of penetration is going to be. And so that's kind of the economics part of the argument. There's also further context to be set in the fundraising environment today. So if we look at kind of deal room data and look at VC funding quarter on quarter, sorry, this is a lot to take in one slide. And there are a lot of bars, but it's essentially quarter on quarter funding at different stages. So like different deal sizes across the kind of European VC ecosystem. And if we look at Q4 2022, you can see that it is as low as, if we go all the way back to the kind of end of 2020. When COVID hit, we saw, of course, a relatively large jump in funding that was sustained throughout 2021. Well, after COVID hit, there was an initial recovery, and then there was a kind of uptick in activity in the early stage venture market and later stage venture market, which meant that there were much larger rounds, there were many more rounds, and valuations kind of went sky high. What we're now seeing is a bit of a correction from that, or at least a return to a longer term average. And so one thing to be conscious of is that there are VCs in the market today who are deploying at a slower rate. It goes all the way down to kind of the rate of exits, liquidity at that stage, and also ability to fundraise as a fund. A lot of that part of the market is becoming harder. Like there are fewer exits, there are fewer IPOs, which then in turn means that it's harder for funds themselves to raise money, which in turn means that they're deploying capital at a slower pace. And so generally speaking, it's a bit of a harder market to raise capital in today. It doesn't mean that it's impossible. And I'm sure, you guys have a great chance of raising a round of funding and kind of getting off to the races. But just to add further context, that there's a bit more friction and we're seeing rounds take a bit longer today, which I guess makes this presentation a bit more topical because hopefully these are some things that can help to speed up the process as well.
I have a question, if I may ask, about the graph that you're showing there.
Yeah, go for it.
Yeah, I noticed that the general trend is that for the bigger funds, there has been more investments, but for the pre-seeds and seeds, basically nothing has changed since 2013. And actually, it seems to have disappeared towards the ending of 2022. Does it change anything for the companies at the beginning who are still trying to raise funding? Since, of course, if you're a bigger company, there's a lot less money around, but for a seed company, nothing has changed. No?
I would say this graph is unfortunate in that like you can't really see the hard numbers for like angel round funding and seed funding, at least from what we've seen over from let's say late 2020 through to about 2022. There's still significant levels of activity, and if anything, a lot more seed funds being spun up as well. And so what we saw over that period of time is the size of seed rounds also grew. So it kind of went out of the 0 to 1. Well, for many of them, they went out of the 0 to 1 and were raising 1 to 2. And some of the companies that were raising traditional seed rounds were raising 5 instead, for example. And so maybe they were crossing over into like Series A territory, if you were to define it in dollar terms, whereas in fact, they were still seed stage companies. So I think it's a bit of an imperfect view. Today, I would say, generally speaking, angels and seed funds are deploying at a slower pace. Angels are deploying a lot less capital, it seems right now. I would say seed funds are deploying, but they're deploying smaller checks. And we're seeing a lot more rounds being syndicated between a few more investors as opposed to kind of one large check, if not these companies writing slightly smaller checks.
Okay. Thank you.
Yeah, no worries. So I guess preparing for the raise. So you've decided you want to raise a VC round of funding, let's call it. Next question is, how much capital do you want to raise? I guess a big part of VC is assuming that you are working to particular milestones that will either allow you to reach a certain point in your unit economics where you can start to build an enduring company, or be able to prove to the next set of investors that you have proven, your product market fit, you've proven some function within your go-to-market, and you're ready to take on more capital to continue scaling or begin your scaling journey. And so when we look at, let's say, pre-seed to seed, I think a lot of that is kind of chasing that early product market fit. And a lot of it is productivity and kinetic energy. It's kind of having a good C-suite, having like a strong team early on who are continuously iterating. And so maybe it means that you have early versions of your product and modest traction, but those early users are highly, highly engaged. They're people that feel the problem more than anyone else, really. And they're willing to spend both time and maybe a bit of capital with a product that's imperfect today, but that's solving such a visceral need for them that they don't care anyway. So we kind of see the pre-seed and seed stage journey about that. And for us, that is a signal of product market fit. It's like, okay, we brought this product together with bare bones, with little resource, but people are highly engaged. People are using this. They love this. And so we need further fuel to develop the product and then start to develop our go-to-market on top of that. And then, kind of seed to Series A, it's, okay, you're getting some of the traction that you need to be able to show that you have product market fit. Maybe you have a core, like small base of users, and you start to kind of press on that. So that's moving from like pilots, for example, to, some paid work, some deployment of your software, of your products. You start to have some of those heads of function in place as well, assuming that by the time you raise your Series A, each of those individuals is going to start scaling their team. And so we want to be investing at a point at which it's kind of clear what the plan is, or at least you have an idea of where you're going to invest further resource. Usually that's sales and marketing, further product development. Maybe you're developing product number 2, or at least feature number 2 in like an existing product today. And then, yeah, we're kind of seeing us being the inflection, like when it comes to sales at Series A, at least. So yeah, all of that is like this distilled down into people plus infrastructure spend and product spend plus, you know, sales and marketing, and then some miscellaneous spend, assuming that you have some contingency plan. So it's reaching the next set of milestones for most people at the early stage if they're building a venture scale business, plus some level of contingency, maybe 5 to 10%, assuming that you want a bit of a capital buffer there. And I would say if I was giving this presentation maybe 12 months before, people were raising for about 18 to 24 months. Today, the mood in the market is very much, we're raising for 24 months at a minimum. We're seeing a lot more kind of seed stage companies, a lot more Series A stage companies and beyond saying, okay, we need 2 years worth of runway. We need to make sure that we have enough time as a business to be able to prove a number of different things out. And so, yeah, I would say today, some of the questions being asked is, you know, how far can you go with the same amount of resource, potentially fewer resources, seeing a lot of companies come out to raise less money than they probably otherwise would have if this was, you know, the kind of top of the market. And so the kind of topic of conversation very quickly switched to efficiency and how you can maximize the resources that you're getting. So, you know, per dollar, like how much value can you create? I guess the fear is that, you know, you can very easily start to not spend where you should be spending. And so the one piece of advice that I would give here, of course, you guys understand your businesses much better than anyone else. And so you know where to spend, you know where not to spend and how to be lean and efficient. So don't get too stingy. You know, there's a fine balance, I guess, between being lean, but also being able to invest in some of your big, bold bets. Some of the way that we see spend, for example, is, especially if you're starting to build a user base, maybe 75% of your spend, let's take like sales and marketing for an example, maybe 75% of that spend is going towards exploiting what you know works, exploiting that kind of existing user base that's getting you great traction. Maybe 15% of that spend is somewhat exploratory. And so maybe the kind of next channel of acquisition, the next channel of users that you think shows you good signals. And then maybe you reserve 10% of that for some of your crazy, wild experiments, just to see what bites, what sticks.
Question about that one?
Yeah, go for it.
When it comes to the budget that is created by the startups, it can come that, let's say if there's 100K that they're looking for raising, or let's just say 1 million, and they need to hire personnel. Usually the salaries costs would be somewhere around 60% of the total fund that they need to raise, or maybe even 70%. How is the sentiment of this when it comes to the investors, to see that most of the money, or a good amount of the money that they're investing, just goes to salaries, and then the rest of that actually goes to, you know, maybe materials or other types of things that you need to pay to make the startup go?
I mean, it's always been the case. Like, we see minimum 50%, if not more, going towards salaries. But of course, a good chunk of those are going to be engineers who are essentially building your product, right? A good chunk of them are going towards, you know, a team for go-to-market. And so that's going to be sales, that's going to be marketing. Like, I think that's the norm, actually. And like, if someone were to react strangely to that, like we would look at that as normal today. And I think investors continue to see that as normal. It's not that your salaried amount as a percentage of your budget is going to shrink significantly. I don't think that's the expectation. It's probably more looking at the hires that you need to make with a bit more judgment and deciding, okay, like, do I need that
personnel for things?
Yeah. So like, for example, if I'm a seed stage company and I'm raising maybe $3 million, like, do I need my VP of engineering today if I have a CTO and maybe a 4-person squad? Or can that wait until I'm at the point where I have 6+, and I need someone to come in to start managing those engineers as my CTO goes off and explores other things? Like, it's kind of making some of those trade-offs. One of the things that we've been advocating for is making some of these hires performance-based as well. And so that is particularly useful when it comes to kind of like sales and marketing, for example. Like, why hire 5 SDRs today if like it's very hard to have all of them be productive and rank them all equally if you're a team with little resource, for example.
What's
it's like
an
making
SDR?
sure it's like a sales development rep.
Okay.
But like it's kind of staging some of these hires to make sure that when you have signal that things are going well and that you can scale, then bringing some of these individuals in, as opposed to like hiring a lot and then having to scale back, if that makes sense.
Right. Okay, understood. Similar with the milestones thing. Like if you hit milestone A, you can keep going
Exactly.
and hire more people, and milestone B.
Exactly. It's letting your milestones unlock further hiring.
Yeah. Okay. Thank you.
Yeah, no worries. So yeah, I guess what do we need to do before we start to engage with investors? This is like a general checklist, going through kind of your initial materials prep and making sure the house is in order. By the time you're starting to talk to investors, the process can go much quicker than you expect. It could go slower than you expect, but regardless, you want to make sure that you're in this position of power where you have all of the resources that you need, and you yourself can be the one to stage gate. So if you want to run a process and you have a number of investors in mind, you can like kind of drip feed them some of the relevant pieces of information, starting with the pitch deck and all the way through to the data room. If you have a few customers today, if there are customers that are willing to give you a case study, or maybe be a customer reference at the point at which an investor is doing some due diligence, making sure to warm some of them up early. And so going out to them maybe 2 months in advance or a month in advance and being like, hey, thinking of this, it'd be useful if you could provide a customer reference at some point. It's part of our due diligence process, and it's part of the DD processes of many different investors as well. So I guess you don't want it to be a shock, especially if they're a really good customer of yours, or maybe they're slightly sensitive of things like this. You'd rather find out sooner, or you prefer to find out sooner rather than later. Do a few practice pitches, whether it be with people in your network, investors in your network, other founders who have successfully raised. Make sure that you've got a few rounds in your belt of questioning. And I think just being able to like listen to yourself tell the story is very useful. You can see where you need to spend a bit more time, maybe what doesn't quite come across the way that you thought it did. And so I would say, using your founder networks, using your existing investor networks as practice is quite powerful. And then off the back of that, starting to build up a master list as well. So deciding, okay, who are the 30 investors that I want to reach out to? Who are the 50 investors maybe that I want to reach out to? Of course, there are big databases now online. There's like Odin's database of investors. I think recently we just like responded to someone who's building a new database of investors. So I think today we're easier than ever to find, especially because every investor has a marketing function today and is writing articles, is trying to get their name out there in a relatively competitive investor market, which plays into your hands as a founder. It's to your benefit. And so I'd say, make sure you spend a good amount of time qualifying these investors, understanding their portfolios, understanding what they invest into. I think it takes probably less than 10 minutes to read an about us page for an investor and maybe look through the portfolio, have a quick scan, whether it be on their website itself or in a database like Crunchbase, just to kind of get a gist. Like if you're a clothing startup, then naturally you're not going to approach a life sciences investor, even if you have some machine learning component in your product and they say that they invest in machine learning. So it's just making sure that you kind of have that view. And then if you have any of them that are existing connections, warming them up, maybe going for an early coffee here or a catch up there, and then mentioning like, oh, in a few weeks or maybe a month or two, we're going to consider raising a round. Just to make sure that, they're thinking about you, they're kind of keeping track as well. And then finally, assuming that you get to the point where you start to get introductions or request introductions from people, preparing your blurb, preparing like kind of 3-4 sentences that describes what you guys do, the stage that you're at in a very succinct way, along with the pitch deck, just so that there's a consistent story being told across the board. But we'll dive into detail on these points. So the first thing is you're gonna have to tell your story, and people do that through a pitch deck. So my second question to you guys is, what makes a good pitch deck? And I'm sure you guys have designed them kind of time and time again, or like, some of you may have gone on this journey. Maybe you're in the process of designing your pitch deck right now. And so, I would kind of put out to the audience, to all of you guys, what do you think makes a good pitch deck?
one that has the problem, solution, market size, traction, and those types of things.
Yeah. So
Very
ticking
clear.
off the kind of common pieces of information that you need to cover. Yeah. Is there anything else?
Connects with the emotions as well as the logic.
Yeah. And a big part of that is, I guess, telling a good story, making someone hopefully feel the problem. And also by the time they finish, kind of clicking through, you want them to be excited about the opportunity, right? A lot of this industry is about how excited you feel about a particular opportunity or a particular team or a particular problem. And so, yeah, it's kind of encouraging both sympathy and empathy with regards to the problem, if you can, if it's something that they felt, and then getting them excited towards the end. And yeah, maybe one final answer. Is there anything that anybody else has?
Yeah, I think it's one that articulates what the problem is, why you're best placed to solve that problem, and why they need to invest in you now in order to solve that problem. Or
yeah, so timing is a big part of it. It's hard for most people to time markets. I think very few of us are like experts in timing because we don't know what's coming, right? Like we don't have a kind of mystic ball where we can predict the future perfectly. And timing is more often lucky than it is premeditated and planned. But you have to kind of give your pitch as to why you think it's the right time. And yeah, that's part of the investment decision that they make. But yeah, those are all great answers. I would add on to those kind of clear and concise, presenting a kind of vision, a thesis for, what the world looks like when you guys have, solved this problem or are solving this problem. And yeah, like the kind of narrative of the problem and the big vision as well is great. So some of my tips when it comes to kind of pitch decks and pitch deck designs, I would say start off with 2 decks actually. So you'll have your kind of pre-reading pitch deck, let's call it. That'll be the first version that someone receives in their inbox. This is going to be the shorter one. It's going to be the one that is more on the concise side, that just covers the kind of big points, right? So the problem, the solution, team, market, competition, etc., etc. Maybe this is 10 or 11 slides, and it's almost like it's a pre-meeting pitch deck, let's call it. It's something that will kind of get the investors' ears perking and be like, oh, okay, I want to find out more about this. You have to be careful of not offering up too much information immediately. You kind of want something to be easily digestible at first, and then you offer up the information. And yeah, you also don't know where this pitch deck is going to land ultimately. The assumption is that like most investors keep it to themselves, but they'll send it to other investors as well, and people will discuss things. But yeah, I would say keep the kind of initial pitch deck on the lighter side, on the shorter side. And then you'll have another pitch deck, which will perhaps be a bit longer. It'll have a bit more content in there. So maybe some more things related to the technical side of the product, how you see the market developing. And yeah, if there are questions that you think you can preempt that people are going to ask you, whether it be about the market, about the product, about the kind of ideal customer profile, for example, you include that in that deck. And then when you're going through the meeting, you use it as an aid. And so you will flip to the appendix where you have some of this further content and show off a slide that, maybe helps you to explain a particular concept. And so, yeah, I would say divide it. And then what you can do is you can use the second deck as a resource, because that's then something to be wanted by the investor. That's, if they're interested, further information that they want to get their hands on. And so you are then able to use that second pitch deck, the longer one with a bit more information, as something to send as a follow-up post the meeting as well. And so it's just making sure that you have some of these touch points as well. And so, yeah, in terms of kind of nailing the narrative, of course, we've talked to a number of these questions, but, the kind of big valuable problem that's being solved, being the right team to deliver that solution, some of your early traction, whether it be, feedback that you've gotten, people signing up, even if you don't have a product live yet, things like that. And yeah, kind of considering what the competitive dynamics are in this market, like where do you think your deep moat develops over time? One thing I would say, I know it's kind of your narrative and your story, but sometimes you have to invest in a deck designer as well. And, like I'm a god awful designer. I'm not sure if you can tell from this beautiful page. But I myself, if I was starting a company, I would probably invest in a designer to help me with my pitch deck, just because they'd do a much better job than I would today. And so, yeah, it's something that I often encourage as well, especially if you're running something that has a consumer-facing aspect to it. It's a bit of a shallow point, but design matters at the end of the day. The content could be great, but people want something that's visually pleasing to look at. And especially if you have a company that is selling to a end customer, like a B2C company, let's call it, or even a D2C, whatever it is, the deck itself and the design in the deck may be used as, kind of a heuristic of your ability to build something attractive, your ability to build an attractive product, because ultimately the deck is something that's meant to attract investors, and it's another heuristic for your ability to storytell. And so I would say investing in a designer is probably more important than you think, just because people are using that to kind of make further assumptions as well, even if they're not actively thinking it. But yeah, that's kind of my opinion. I spend a lot of time investing into cybersecurity companies, and I find very few cybersecurity companies who have invested in a deck designer. And so, yeah, it's something that I wish would change about that space. But equally, I have to grit my teeth and work my way through these long pitch decks and be like, okay, just get to the information. But it's probably more important than you think it is. And then, yeah, as we've mentioned before as well, just like rehearsing, making sure that you're practicing with warm connections, even if you're pitching to your dog or your cat. I mean, just get something to sit in front of you and spend 20 minutes going over your story. It's just, I'm getting that repetition in.
Just on the cybersecurity example, if they're not getting to the information, what are they doing?
They're selling me on the market, on the size of the market, the opportunity, the depth of the problem. Right. It's another thing, like, you are the expert and you understand your product, you understand your space and market, and probably feel more passionately about it than the investor. So it's probably easy to kind of overdo it on that side. But yeah, another important point is being concise and kind of getting to the point. But yeah, I get a good amount of decks where it's like almost a teaser, but it's spending like a full page. Well, these are like A4 pieces of paper, like information sheets sometimes, just telling me about the problem or the market or something like that. I would say you don't need to spend as much time, like you'd be surprised. Maybe if it's more complex and you're speaking to someone who's a specific expert in that field, but more often than not, you're probably going to be speaking to someone who's somewhat of a generalist. And so, yeah, there are a few points of detail that you need to offer up immediately.
Thanks. I think we were told that we have to spend some time on the problem, because then when we have the solution, the people will get more excited about it. But I definitely hear what you're saying and take your point about getting to the point, because at the end of the day, I think most investors are pretty smart and have seen a lot of things, and they can make up their mind pretty quickly. So I hear what you're saying.
Yeah, you're kind of, so this is me talking about DAX specifically, not necessarily conversations. In conversations, when you're on the phone, you will explain the problem, of course. But yeah, you want to be careful of kind of overdoing it or spending just a bit too much time on it. People are egotistical, investors are egotistical, and many of them will either think they understand the problem or like assume that after a certain amount of reading that they have understood it. And so sometimes it may be like, I don't know, kind of like talking to a child almost. You need to make them feel like, okay, they've got it. And then you move on, because there are so many pieces of information that they need to collect in those 30 minutes that you do need to kind of hit some of those points quite quickly. And then a lot of, like, you will kind of veer off path, and a lot of it will be Q&A anyway, right? So yeah, just keeping that in mind. Also conscious that I said that I would blaze through this, and I'm not. But yeah, so that's the pitch deck. Yeah, in terms of how long investors spend on pitch decks, there are a number of stats out there. It is important, but yeah, some people may blaze over things in like 1 or 2 minutes. Others may spend much longer. For us, we're quite religious about how much time we spend preparing for a meeting. And so we'll probably spend a bit longer than others, but one of the things to keep in mind is, okay, yes, it's upfront work, it's a lot of work, but the decision to invest is probably mostly based on you. And so it's going to depend on their first impression of yourself as well. And the pitch deck may end up just being a resource on the side. Well, it is a resource on the side. But yeah, just keeping that in mind. Moving on from that, you'll have a data room in place, of course. And this will cover the kind of core aspects of your business. You release the data room at a point at which you feel like conversations with that particular investor are getting serious and they need to learn a lot more information. And so it will include things like, your pitch deck, maybe some product and tech information, some more legal information as well, and your financial model. So what your operating model looks like post the investment, as well as maybe some historicals. And then, a few other things related to team and the market as well, just to help them come up to speed. One of the points that I'd make, or the most important point that I'd make with this, is split it. Have kind of a data room number 1 and a data room number 2. The data room 2 being the kind of larger hub of information that includes some of the more important points. So like the full financials or like legals in there, whether it be your articles of association or contracts with existing customers, for example. You don't want to offer it all up immediately. People will often make data requests where they'll request maybe 3 or 4 specific pieces. If you can provide that within like let's call it like a individual data room for that fund, then maybe do that. You could just copy and paste your data room, delete the items that you don't want to be in there, rename it to data room for MMC, make them feel a bit special, and then you can share that directly. And then at least you have this kind of trail of what you're sharing and what's in each fund's data room as well. But point being, you don't want to kind of overload them with information as well immediately, and they'll kind of come to request it as well. One thing that we've seen being used more and more is FAQs. So not necessarily data rooms, but founders kind of sitting down and typing up the answers to what they think will be investors' most asked questions. And so this may just be like a Word document, it may be a Notion document. We find that like the story that you tell to an investor it's probably going to sound relatively different by the time that they get to telling it to their team. It's almost like Chinese whispers, because they're trying to type and write notes as you're speaking in a meeting. And then they're remembering different pieces, doing their own research, including some of their own thoughts. With this type of document, you're kind of making sure the narrative is as consistent throughout as possible. And so maybe just thinking of the top 10 questions that people will most likely have and writing down your responses would be quite useful. And then that becomes a piece of collateral as well for you, right? So maybe post the meeting, you send them your full deck. If they've gone a bit cold, maybe after a week or two, you send them the FAQ just to clear up any points or any questions that they have. You can pose it as you helping with their research and giving them further resource if they're interested. Or maybe they'll come back to ask for something like this. And so, I would say it's a good way to shortcut some of the process, especially if you're trying to bring people up to speed quickly. And then, all of this is a process, right? And so making sure that you leave yourself with enough time. We're seeing the amount of time that it takes to raise some of these rounds stretch slightly. So just making sure that you have a good enough kind of buffer of time. Some of it will be gathering those early commitments, and then, giving yourself enough time to find the lead, go through due diligence, et cetera, et cetera. It's probably closer to 6 months now than it is those 3 months. There are some seed rounds that, we first engaged with in like February, for example, that are still ongoing and probably going to close maybe like later in the year. So things have stretched slightly, but making sure that you have a buffer and a clear plan around that is important. And then, this is a sales process. And so having your CRM set, having a long list, I would say, have maybe 30 plus names on there. You'll tier them as well, depending on, who you see as like your ideal investor. And then within each of those funds, you want a champion / a partner. Like you kind of want to have a sense of who you'd be working with and where they are in the process as well. So just as they're putting you through their funnel, you're putting them through your funnel as well. Okay, finally, getting in front of investors. Of course, today, warm intros continue to dominate. And so where you do have a network, where you do have, kind of friends, family, angel investors, use them, but particularly use founders. I think founders is a way of introduction are relatively underrated and underused from what I've seen. If it's a founder in that portfolio, it's a very powerful way to get in front of them. Because of course, like these are people that we backed with our own money. And so we trust their opinion. We trust many people's opinions, but when it comes from a founder that we've backed, it's something that we, immediately jump on and take a look at. A lot of our founders, when they get to later stages, will start angel investing. And so that will become, a source for us to find new companies. But the founders in your network who have raised capital are a very good way to get in front of investors. Of course, not everyone has the kind of access to investors that they may otherwise want. And so in some cases, you are going to have to go cold. I would say when you are, try and avoid some of the longer messages. Again, similar to the pitch deck advice, make it concise, make it short, making sure that the subject line, like from the get-go, what they see sounds interesting. It's kind of giving them a sense of who you are, the stage you're at, how much you're raising. And then, working through some of the other things as well. So you want it to be somewhat personalized. I know that's not highly scalable and it's easier to click kind of go on a general copy, but maybe take some time to go through their portfolio and make a comment related to one of their companies. Okay, you're a cybersecurity investor. I saw that you invested in this email security company. We're doing something in this adjacent field and we think we're somewhat complementary. Or maybe you wrote that blog on this particular thing. I thought that comment was interesting and I'm actually working on something similar. Like making it somewhat tailored, somewhat kind of related to them and the way that they invest is a very good way to start. I think at the minimum, it gets you a good response because you've taken the time to research them. And of course, they're at that point, probably happy to take the time to make a proper decision and give you some feedback. And then, just making the process as quick as possible. So like attaching your deck, attaching a calendar. And then, other ways in. We have a number of office hours today that are useful to get in front of investors. So things like Playfair Capital's female founder office hours, Founders for actually do quite a lot as well. And then there are more and more funds who are doing very verticalized and specific office hours. So for example, we did one with Nata Capital, who are doing a DevOps office hour. And other funds will have kind of office hours related to specific streams, whether it be fintech, consumer, enterprise software, etc. And so one way to keep up to date with a lot of these is just following a number of these funds on LinkedIn as well. Like you will come across some of the things that they're hosting or signing up to their newsletters and they'll land in your inbox. And then of course, pitch competitions, things like, MSDUK once you've gone through the Accelerator. And then there are a few who run pitch competitions that are not attached to specific accelerators. So for example, the seed stage, they've now rebranded to Focal and DS Live as well. And then beyond that, the various events and conferences around Europe, around the UK. So I guess third question, how else would you get in front of investors? Like, what have I not mentioned that you would do to get yourselves noticed by a particular investor or in front of them?
So we helped a couple of prop tech startups by organizing an event and inviting 30 odd people. So that was at Imperial College's place in White City. Yeah. And so some of them were investors, some of them were professional services lawyers and so on. But it worked pretty well. So that's a way to do it, I think, creating your own event.
Yeah, creating your own event, especially if it's targeted at like a specific network or a specific vertical. So maybe you are a fintech company and you put on a fintech event where you invite both founders, but maybe some investors as well. And it's specific. Maybe it's related to, how people manage their like payables or invoices or something like that. So using your knowledge and using your niche and putting on an event is a great way to go about it. Anything else?
I've been approached by, I think, a couple of venture capital companies. So the latest one was Connected. I presume it's from my LinkedIn profile and maybe from some kind of thought leadership content that I've put out there. But I'm not sure, how they got hold of me. Possibly LinkedIn.
You should ask them.
Well, I intend to when I haven't yet responded, but I will respond and find out. But I don't
like,
know.
Maybe when you get on the call, how did you come up? Just out of curiosity, how did you come across it? So that brings me on to my next point being these three, I think, are becoming a lot more important for many investors. So of course you have the conferences, communities, accelerators, etc. But a lot of investors are becoming a lot more data driven when it comes to the way that they source, and a lot more research driven as well. And so one of the points to make is you want to be highly discoverable when you are at the point where you want to start raising. And so having a Crunchbase account and having a company Crunchbase profile, for example, having a deal room account, again, having a deal room company profile. A lot of investors are scraping many of these sources and then doing a lot of like Frenching to find companies in an automated fashion. And so you want to be within that batch, right? And you want to be able to tailor the language on some of these public profiles that investors are often tapping, such that you make it through those filters, right? And so I would say, if you don't have one of these profiles and you're raising, set one up, make sure it gives a good description of what the company is, has your kind of right industry tags. And yeah, if there's already an existing profile out there somewhere that they've managed to scrape, reclaiming some of that, reclaiming access to that, and then writing your own narrative is quite important. And so, yeah, I would say make yourself discoverable, even if it's you going on LinkedIn and becoming a stealth mode founder, for example. You'll all of a sudden find that like 2 or 3 or 4 associates inbound you within the same week because they've all been looking at the same data tools and have come across your profile on them.
Sorry, you said a stealth mode something. What did you say? What was that?
It's just when founders go into stealth mode on LinkedIn. And so as opposed to having their current startup, they may say stealth mode startup instead.
Startup of startup? I'm not sure I understand. So you create a whole new profile and then you
No. So on your existing profile, you may say that you're in stealth, like you're operator, like you're founder and CEO of the startup, as opposed to like the company itself.
So you remove the name of the company in your profile.
So you don't change them. I mean, if the company's profile is up there and you're already on that, like I would leave it. But it's probably more advice for pre-seed stage companies who haven't maybe made a big splash. So leave the company profile alone. Don't change or remove the name of the company. You could just like delete it from your experience block on LinkedIn on your profile and say stealth mode instead, if that makes sense.
I can't say that I'm fully understanding what the strategy is, or at least the practicality of using it on LinkedIn, because I can't seem to understand why you wouldn't want your company's name to be on your profile.
Because a lot of the scraping tools are looking for kind of stealth mode founders, at least at pre-seed. And so one of the ones that has become table stakes for a lot of investors, for example, called Spectre, it scrapes LinkedIn for people who have started businesses recently and are in stealth mode, and then gives them a rating for a particular company, for a particular VC. And that way you're kind of at the top of the data feed for a lot of these investors. So yeah, it's like a new way of scraping and a new way that founders have kind of been, or a new method a bunch of founders have been using to signal to the VC market that they're building, but they're not ready to come out yet.
I see. Okay. Well,
yeah,
thank you.
Yeah, no worries. Conscious of time, I didn't realize we're already at 4. So I'm gonna race through some of these slides quickly, and then yeah, we can maybe have like 10 minutes of Q&A if you guys don't need to jump off. But yeah, in terms of conversation best practices, we've already kind of talked to some of these things, but yeah, pre-conversation, of course, sending the pitch deck, doing your research on the VC itself, and so maybe answering some of the questions for yourself, like, if they announce their most recent fund, okay, where did they kind of get their money from? Do they mention some of their LPs? And also just making sure that you have interesting questions for the VC. Like when we get to the end of calls, most founders don't ask us questions, or maybe just ask us about what the remainder of the process is. If you do get the opportunity to ask questions and there are maybe 5 minutes left, make sure to do some of your own due diligence, but also try and ask them some interesting questions, because it's another way that you start to stand out as well. And yeah, you have to balance that with asking too many questions. So if you have 2 or 3 prepared, and maybe it's related to something that that person wrote, maybe it's related to a particular portfolio company that they sat on the board of, but having something like that in your back pocket, I think is a good way to build up conversation. And then, yeah, scheduling meetings with a buffer, making sure that you're not having to jump off from meeting to meeting. It just gives you more time to digest what happened and then prepare for the next one. It's an obvious point. But yeah, like we often have it when founders' rounds are really busy and they're jumping from meeting to meeting. And it's like, you can kind of tell when they've just come off of a meeting with another investor as well. And yeah, asking for intros, like if someone turns down, if they don't provide particular pieces of feedback, or if they do, I mean, feel free to ask them, you know, are there any other investors that you think I should reach out to or that you think I should be connected to? If every one investor you speak to gives you 2 intros, then yeah, that's super positive. During the conversation, again, obvious, but you'd be surprised at how often people don't do this. Introducing yourself, telling your story first, telling the history of the company. You know, even today I had a call where founder jumped immediately into the technology. And I was like, wait, okay, I need to understand who you are first. And so make sure you kind of slow it down and remember it's you building a relationship with that investor, right? And so they kind of need to get the gist of the story, the evolution of the company so far. Keeping responses concise. I feel like I need to practice what I preach. My presentation hasn't been that concise. But yeah, again, if you've got 30 minutes to cover a lot of ground, of course, you can go down a few rabbit holes here and there. But make sure that you're answering at a level that's sufficient. And then if they want to dig into further detail, you can. But yeah, knowing that there's a number of things that they need to learn in 30 minutes, just keep that in the back of your mind. And then, yeah, make the deck a visual guide, but don't stick to it too rigidly. You don't have to show every single slide, and people are probably going to jump around and ask you questions related to different things. And then, yeah, one of the important things, note down all of the questions that they ask you. They can feed back into your FAQ that you end up building. But it's also just to understand, it's also useful to understand if there are patterns in the questions that investors are asking you, if they seem to care about one side of the business more than another. And so just starting to build some of that pattern recognition for yourself, I think makes it easier for you to sell the business in future conversations. And then, yeah, other things, other small things like closing down all of your tabs. Like a call we had recently, the founder had his investor CRM open. And so we're like, yeah, we were talking to those guys the other day. And then, yeah, like some of the things like avoiding so what did you think immediately? Like give them time to digest, and asking some of those interesting questions. And then, yeah, post conversation, review the questions they ask you, build upon your FAQ, and yeah, following kind of send up email, maybe with the FAQ or the extended deck, and then giving them 1 or 2 weeks to kind of go work through everything, process everything. I would say there's an art to the follow-up that you send after those 1 or 2 weeks, if you are the one following up instead of them. And so maybe use some good news to follow up with, or like stage the release of good pieces of information throughout your fundraise so that you have something to send to different investors to keep them engaged, to keep them warm. Maybe it's the announcement of a new feature. Maybe it's the announcement of, you and the company getting some coverage in a particular, magazine, or maybe it's like a new customer who's, willing for you guys to release a case study or a testimonial. But stage good news and then release that good news, like drip feed it to investors, such that when you're getting back in touch, there's something positive to go off of before you remind them of kind of where you are and inquire what their process looks like from here on out. Okay, there's a lot of information. Term sheets and negotiations, we will come to Thursday, but I guess in closing, research the VCs, understand their LP base, where they got their money from. And yeah, when you get to the point where you are like, this is when you get to the point where you're like getting ready to sign a term sheet as well. You should do your references on the deal lead, whether it be through portfolio references or others. And yeah, make sure you're the one that picks who you get to use as a reference. So it can't just be all of the companies that scaled well. It has to be some of the journeys that didn't go according to plan, so that you understand how they behave when the going gets rough. And so yeah, I guess that's the majority of my advice. So my quick don'ts: NDAs too early. Most VCs have a lot of conversations, and so don't tend to sign NDAs because it's hard to then track. Yeah, probably don't pitch your ideal VC first. Maybe make sure that you're starting with some of your tier 2s, your tier 3s, just to get some practice in. don't have too many people on the call. Yourself, maybe one of your co-founders is more than enough. I would say if you have an advisor, for example, make sure they're not on the call. Like you want it to be a bit more of an intimate setting where you're very obviously building that relationship with the investor. First offer you get, obvious jargon, defensive on answers, something that's kind of personal to me, but fundraising advisors, I think are a bit kind of touch and go. There are some really good ones out there in the market, like some really, really good ones who do a great job. But there are also seemingly today, as venture becomes much more of a kind of larger asset class, a lot of people who seem to be selling snake oil. And yeah, if you could see the emails that they send in our inboxes, then you kind of understand that they're not doing a great service to the companies that they're working with and taking equity from. So yeah, I would be wary of some of the fundraise advisors that approach you or that you approach, and just make sure you do your research. Again, there are some that are brilliant out there in the market. But yeah, like more often than not, they're kind of sending a templated random email, like cold email to a large kind of scraped database of investors who they don't necessarily have relationships with. And then, yeah, don't press. Sometimes you have to be patient. And again, when you are engaging, making sure that you're engaging with particular pieces of news that are positive, that reflect great on the company, and you can do things to manufacture that. Okay, there's a lot of information. Sorry, guys. It's too long of a slide deck, but those are my fundraise do's and don'ts. I know a number of people have had to jump off in the meantime. And so, yeah, I'm sure if they have questions, more than happy for them to send them via email. But yeah, I have like an extra 7 minutes before I have to jump. So happy to answer any questions if you guys remaining on the call have any to mind.
Awesome. So before we open for questions, I will quickly jump in. You got Shazida at the beginning, you got me at the end. All I want to say, Masamba, thank you very much. To our cohort who's left, I hope we can see you on Thursday for the second session. And I just wanted to plug in a reminder about those pitch decks for our demo day. So if you're still working on it, deadline is Monday. Let us know if you need anything. And with that, thank you very much, and see you on Thursday.
Hey,
Thanks.
thank you, Carolina.
Hey,
Can I?
Masamba. Oh, sorry. Go. Sunny, are you going?
Sophia? Can I ask a question? So in terms of the LinkedIn, should we spread out the word of on our LinkedIn profile about stating how much we're asking for if we're doing the fundraising? Or should
I
number
would say, yeah, I would say keep that private. The amount may change. And yeah, I think you want to hold some of your cards close to your chest as well. So yeah, I would say it doesn't, like, you don't need to have a LinkedIn post with the specific amount that you're raising. It's also something to consider like further down the line if you like have competitors in the market as well. Who'll have certain pieces of information on the company. You don't want everything to be out there in the public domain. And yeah, you want to allow yourself for some flex as well, right? Like the round may grow, the round may shrink slightly. So yeah, I would keep that private.
Does that mean that we probably need to spread off the word by saying we are looking for the funding, but just
yeah, I would say most companies that we engage with don't announce that they're fundraising. I think most of them just come directly to us. So yeah, I think best practice is probably not announcing that you're fundraising. If you get to that point where you need a few more leads, then perhaps consider it. But it's easier than ever, I think, to reach investors. Like most of them have their profiles available. And if you can find introductions to them, then that's a great way to go about things. But yeah, today you may not be connected to many of them, and many of them may not see that post. So yeah, I would refrain from that and try where you can to get introductions to a specific targeted list, if not going directly to those individuals.
Okay, cool. Thank you.
No worries. Thanks, Sylvia.
Hey, Masamba. I'm currently fundraising, and I've got one investor interested. I've got a major industry player that have told me what they want. Did talk about investment, but have said they will share our proposition with their extensive network. Now, the initial proposal I gave, I was looking for 3 investors for just under $500,000. And I don't want to give away too much at this early stage. But obviously he's come back and said he thinks we should make it smaller and so on. So it's a bit of a dilemma for me at the moment of whether to get something now so I can start it and get traction and moving and all the things you say, or spend a lot more time finding investors that will come in on the terms that are more favorable for us. Because obviously I need to build some traction. I have some traction, but this is a new venture and it needs a lot of setup costs.
Yeah, I would say, okay, if it's significantly less than what you planned on raising, and also just at a much less attractive valuation, you can be forgiven for looking for other investors. I'd say the thing to consider is like, can you viably get to the next set of important milestones with the smaller amount of cash? So I guess yourself planning out who you're going to hire. Let's say it's instead of 500, it's 300. It'd be okay. On 300, could we get to, the seed stage milestones that we would need to have to then be able to raise an additional $1 million or $2 million? Another thing to consider is the signal that it sends if you're taking on strategic capital really early. One of the things that may be a bias is the fact that you have a strategic on your cap table who have information rights, and they could end up being an early acquirer of the business as opposed to letting the business scale, especially if it's somewhat related to the products that they have in place today. So it's one of those things where, like, if you are going to take that type of capital, sometimes taking multiple sources of that same, like multiple, let's say, strategics as opposed to one strategic can be a bit more helpful. So if them and another strategic, that may put you in a better position than just taking that strategic capital. But yeah, there are investors out there that have a bias against that. Because of the assumption that, okay, these guys can see everything or have certain information rights. And so they could snap this up in a year for much less value rather than letting it grow.
Thanks.
All right. Okay.
I wanted, you have one more time.
No, go for it.
I wanted to ask about the stealth mode startup again. I see that it is a company on LinkedIn. So are you supposed to put that you work at that company, or how exactly does
you don't absolutely have to do this. But as you can see, I'm sure that company has like a few thousand employees right now.
I see only one, but yeah, 339 employees. But I'm sure there are other versions of it that has more.
Yeah, there probably are. I would say, yeah, like people who are starting new companies, we've often seen them say that they're working at this company, for example, and they'll say founder and CEO of that company. So if you click on the employees, if there are 300 of them in this case, you'll see many of them will be like founder and CEO or founder and CTO or whatever it is. And they use that again as a signal to VCs that these guys are building, and they like the investors should be keeping an eye out for them. So we will use scraping tools that scrape LinkedIn. And when we see one of these, for example, it would come into our CRM, if assuming their background kind of matches some certain things, and then through the company that we've been working with, they're given like a particular score. It'll maybe come in as someone that we should be watching out for. And so that would go into our CRM and say, Tyrell's stealth mode startup, and remind us that, okay, in 6 months' time, we should actually see what this guy is building. Not every fund is like that. But yeah, we're seeing more and more people use this method to kind of attract a few investors and attract attention from them early. You don't have to use that method. I wouldn't prescribe it to everybody. It's just something to mention as a part of kind of getting your name out there as well, and making sure that you have a presence on some of the data tools that investors are using.
Right. And would you actually recommend that to anyone who's already put their company on their LinkedIn profile publicly to then go backwards and then make it to
I would leave it. Yeah, I would leave it for now. Especially if you have your company, if your employees have the company on there. I think it's fine. Again, it's more for like people who are just starting out. Yeah, exactly.
Okay.
So often I think some of the people who have that, they haven't even really like incorporated or decided their name, for example. So it can be super early stage.
I see. Okay. Thanks.
I'm so sorry to interrupt. I think, Masamba, you have to go to another meeting, isn't it? I'm policing on time as I usually do on this program.
Sorry.
No, yeah, I have to jump. But guys, it's thank you for, spending the past hour and a bit with me. And yeah, looking forward to seeing you all tomorrow and getting into further detail on some of these things.
Thank you. See you tomorrow.
Likewise. Thank
Bye,
you.
everyone.
Thank you all. Bye.